Assalamualaikum warahmatullah and welcome everyone. In this video, we will continue the discussion on accounting for inventories. In part 1, we have discussed the accounting system for inventories. In this part, we will discuss inventory valuation methods. Let me introduce you to the 3 typical inventory valuation methods. These valuation methods might represent the flow of the goods from the warehouse because at times the valuation methods are used for determining the cost but not really representing the actual flow. Regardless, the first one is first in first out or FIFO. If you can imagine, the first batch of goods that arrived at the warehouse will be the first batch that will be sold. Every time we do sale, we will sell all the goods from the first batch before selling goods from the second batch. Thus the title, first in, first out. So if we want to determine the cost of goods sold, we will refer to the price at which the batches are purchased. It is very natural that we purchase goods at different prices at different times. It can be due to the price changes, or we could benefit from discount received due to buying at a greater quantity than the usual. Thus the cost of the goods will also be different. For this method, it is very relevant to perishable goods, meaning those goods with expiry dates or could go bad after a certain period. Thus, naturally, we want to sell off the earlier batches first before the later ones. The second method is last in, first out or LIFO. It will be somewhat the opposite of FIFO, where we always sell the most recent batch of goods even before finishing goods from the earlier batches. So if you can imagine, when a new batch comes in, we clear off the shelves, take the old ones back into the warehouse and put on the shelves the newly arrived batch of goods. And every time new batches come in, we do the same. Unless the newest batch is not enough to fulfill customer needs at that point, we will take from previous batches as well. So as you can imagine, this practice is quite rare. But one of the advantages of LIFO is when there is an increasing trend in price, thus increasing cost. So the ending cost would be relatively lower since the new ones with higher costs have been sold first. So the lower the closing stock, the higher is the cost of goods sold, and deduct that from revenue, we will get a relatively lower gross profit, thus relatively lower net profit. The advantage is it will mean lower taxable income, thus tax expense. In the US, LIFO is acceptable by US GAAP. Thus, some businesses prefer to report their inventory costs by applying LIFO method because of that tax advantage. However, some are not so keen, as it may not represent the natural flow of their trading goods. The third one is weighted average or weighted average cost, thus WA or WAC. Under this method, depending on the system applied, the cost is averaged out every time new purchase is made. What we're looking for is to determine the cost per unit. So you can imagine if the current available batch is at $10 per unit cost, for example, when a new batch comes in, we need to determine the new per unit cost by combining the existing batch with the newly purchased batch and average out the cost per unit. So that $10 per unit will change to either greater than $10 or lower than $10. The bottom line is the per unit cost will change unless the new batch is also cost at $10 per unit. Under perpetual system, we need to calculate the per unit cost after every purchase because we need to calculate the cost of goods sold every time there is a sale. Under periodic system, we only need to calculate the per unit cost at the end of the period when we determine the cost of goods sold. The formula for determining the average per unit cost is as shown here. Total cost of goods available for sale, which consists of cost of existing inventory plus the cost of newly purchased inventory. And we divide that with the total number of units of goods available for sale of the existing inventory and newly purchased inventory. Let's look at the valuation methods under perpetual system. To illustrate, let's look at this example. We have item 127B and a list of transactions in relation to inventory for item 1 to 7B. On 1st January, we have inventory balance of 100 units of goods at $20 per unit. And then we have few sales and purchases through the month of January. Since we are now applying perpetual system, every time we make a sale, we need to determine the cost of goods sold. For this first round, we will use FIFO method. On 1st January, we have a balance of 100 units at a cost of $20, so that the total cost is at $2,000. On 4th January, there is a sale of 70 units and we only have one batch of goods available, and that is of those with cost of $20 per unit, so we take from that batch of goods to transfer the cost to cost of goods sold account. In this case at $1,400, leaving a balance of 30 units and total cost of $600. On 10th of January, there is a purchase of 80 units at $21 per unit. Therefore, at the end of the day, we have a total of 110 units of goods at a total cost of $2,280. On 22nd of January, there is another sale of 40 units. Since we use FIFO, we will sell the earlier batch first, but it is not enough. So we will take from the second batch to complete the sale. So 30 from the old batch at $20 and 10 from the new one at $21 per unit. At the end of the day, we have a balance of 70 units at $21 from the second batch at a total cost of $1,470. On 28th of January, there is another sale of 20 units, but we have only the second batch to sell from. So at the end of the day, we have a balance of 50 units at $21 each to get to the total cost of $1,050. On 30th of January, there is another purchase of 100 units at $22 per unit. That will add to the existing balance of $1,050 to make the total cost of inventory at the end of the month to be at $3,250. And we can determine the total cost of goods sold for the month by adding the cost of goods sold from every sale made, and we get a total of $2,630. Now please note that you are not required to come up with a table like this, but it will make the calculation easier to understand and it is presentable. That is, if you need to make a report for the month and show it to your supervisor or manager or to your superior. Let me show you how we can determine the same thing without the table. On 1st January, we have a balance of 100 units at a cost of $20, so the total cost is at $2,000. On 4th January, there is a sale of 70 units, thus the minus sign there, at $20, so we have the cost for the goods sold at $1,400 and leaving a balance of 30 units and total cost of $600. On 10th of January, there is a purchase of 80 units at $21 per unit, thus the plus sign there, making the new total cost to be at $2,280. On 22nd of January, there is a sale of 40 units where 30 units are from the old batch at $20 per unit and 10 from the new one at $21 per unit. At the end of the day, we have a balance of 70 units at $21 to get to the total cost of $1,470. On 28th of January, we have another sale of 20 units, but we have only the second batch to sell from, and at the end of the day, we have a balance of 50 units at $21 each to get to the total cost of $1,050. On 30th of January, there is a purchase of 100 units at $22 per unit, which, adding that to the existing balance of $1,050, we have the total cost of inventory at the end of the month to be at $3,250. And we can determine the total cost of goods sold for the month by adding the cost of goods sold from every sales made, and we get a total of $2,630. The closing inventory is already determined at $3,250. Let's use the same example, but this time we will apply LIFO method instead. Now remember, under LIFO, every time we purchase new batch of inventory, we will sell from that batch first. So again, we start with a balance at the beginning of the month of 100 units at $20. On 4th January, there is a sale of 70 units and we only have one batch of goods available, so we sell from that batch, leaving a balance of 30 units and total cost of $600. On 10th January, there is a purchase of 80 units at $21 per unit. Therefore, at the end of the day, we have a total of 110 units of goods at a total cost of $2,280. On 22nd January, there is another sale of 40 units. Since we use LIFO, we will sell from the most recent batch that comes in, that is the one with per unit cost of $21. So the entire 40 units are taken from that batch with a cost of goods sold at $840, leaving 30 units from earlier batch and 40 units from the most recent batch, making the total balance to be at $1,440. On 28th of January, there is another sale of 20 units, and again, we sell from the most recent batch at $21 per unit. Therefore, the cost of goods sold will be at $420, leaving 30 units from earlier batch and 20 units from the most recent batch with a total balance of $1,020. On 30th January, there is a purchase of 100 units at $22 per unit. That will be added to the existing balance, and after this, if we have a sale, the goods shall be taken from this batch at cost of goods sold of $22 per unit. At the end of the month, we can determine the cost of goods sold simply by adding together all of the cost of goods sold from all sales made during the month. The balance will consist of 3 batches. The first batch with cost at $20, the second batch at cost of $21, and the third batch at the cost of $22 per unit. In February, if we have a sale before any new purchase, we will sell from the batch with $22 per unit cost first. Finally, let's use the same example for the third method, which is weighted average. For weighted average, our aim is to find the average cost per unit for all goods available for sale. But specifically for perpetual system, we will do the averaging every time we purchase a new batch of goods. In this example, we have 2 purchases. That is when we do the averaging. So again, we start with a balance at the beginning of the month of 100 units at $20. On 4th of January, there is a sale of 70 units and we only have one batch of goods available, so we sell from that batch, leaving a balance of 30 units at the total cost of $600. On 10th of January, there is a purchase of 80 units at $21 per unit. Since the cost per unit for the new batch is not the same with the existing batch, we need to do the averaging. All we need to do is to calculate the total cost of goods available for sale from batch 1 and the new batch, and divide that with the total number of units of goods available for sale. We end up with the average cost per unit at $20.73, rounded to the nearest cent. On 22nd of January, there is a sale of 40 units. Since we already averaged the cost, it does not matter from which batch we sell. The cost of goods sold will be calculated using the average cost per unit calculated earlier. The balance at the end will be at 70 units with total cost of $1,451, rounded to the nearest dollar. On 28th of January, there is another sale of 20 units. Again, we can take from any batches, it does not matter. The cost of goods sold will be at $20.73 per unit, leaving a total of 50 units at $20.73 per unit cost. On 30th January, there is a purchase of 100 units at $22 per unit. Again, since the cost per unit is different from the average cost, we need to determine the new average cost. So we do the calculation again by dividing the total cost for all available goods with the total number of all available goods. And we have a new average cost of $21.57. Should there be a sale before a purchase after this date, we shall use this new average cost to determine the cost of goods sold and the balance in inventory. At the end, we can determine the total cost of goods sold for the month by adding all costs of goods sold from all sales in the month and the end balance of the inventory from the record. Let me show you how we can do the same without the table. On 1st January, we have a balance of 100 units at a cost of $20 per unit. On 4th January, there is a sale of 70 units at $20, so we have the cost for the goods sold at $1,400. On 10th of January, there is a purchase of 80 units at $21 per unit, so we do the averaging by dividing the total amounts of cost for all available goods with the total number of available goods. On 22nd of January, there is a sale of 40 units. It does not matter from which batch the goods are taken, we simply use the average cost per unit to calculate the cost of goods sold. On 28th of January, we have another sale of 20 units. Times that with the average cost per unit to get to the cost of goods sold. On 30th of January, there is a purchase of 100 units at $22 per unit. Since the cost is not equivalent to the existing average cost per unit, we need to do the averaging again by dividing the total cost available goods with the total number of goods available for sale and get a new average cost per unit of $21.57. In the end, we can determine the total cost of goods sold for the month by adding the cost of goods sold from every sales made, while the closing inventory is already determined at $3,236. Let's now try this simple exercise. We have a balance on November 1st of 40 units at cost per unit of $5, and then we have 2 sales and 1 purchase. We are required to determine the cost of goods sold for the sale made on 21st November and the end balance of the inventory at the end of the month using all 3 methods, assuming we apply perpetual system. Please pause this video and try this exercise. I hope you did try to solve the problem. Now you can check your answers with my suggested solution. So first we use FIFO method. For FIFO, we know that we need to sell from the earlier batch first before the recent ones. Before the sale, we had another sale on the 5th and a purchase on the 11th. From the first sale, we have a balance of 8 units. So to fulfill the sale on the 21st, we will sell the 8 units from the first batch and take another 37 from the recent batch to make it to 45 units. The cost will be 8 units at $5 plus 37 units at $7. So we get $299 cost of goods sold for the sale on the 21st. After the sale, we have a balance of 23 units from the second batch at the cost of $7 per unit. That makes the end balance of $161. Say we use LIFO method. This time, we must sell goods from the most recent purchase. So the entire 45 units of goods sold on the 21st shall be taken from the recent purchase on the 11th. Consequently, we have 45 units of goods sold at the cost of $7 per unit, giving us the total cost of goods sold of $315. At the end of the month, we still have the balance from the first batch of 8 units at $5 and 15 units from the second batch at $7 per unit, making the total cost of inventory at the end of the month of $145. Let's now use weighted average method. Remember, for this method, we need to find the average cost per unit after every purchase. So after the first sale, we have a balance of 8 units at $5 per unit. And then we have a purchase of 60 units at $7 per unit. We add total cost from both batches and divide that with the total number of available goods, which is 68. And we have the average per unit cost of $6.76 per unit. Therefore, when we make the sale on the 21st, we will calculate cost of goods sold using the average cost, and that gives us a total of $304.20. As for the end balance, we are left with 23 units at $6.76 per unit. That gives us the total end balance of $155.48. We are done with application of all three methods under perpetual. Let's now move on to the periodic system, which will be simpler since the determinations of cost of goods sold only happened once, that is at the end of the period. We will use the same example so that we can see clearly the difference in the application. First, for FIFO method. We know that at the beginning we have 100 units of inventory at $20, and on the 10th and 30th we have purchases of $21 and $22 per unit respectively. So for the period, we have 280 units of goods available for sale with total amounts of cost at $5,880. For the month, we have sales of 130 units. Since we are using FIFO, we will sell from the earlier batches, so 130 will be deducted from the top. The first 100 units at $20 per unit cost, and the next 30 units at $21 per unit cost, which leaves us with 50 units from the batch with cost at $21 per unit and 100 units from batch with cost at $22 per unit. And we have in the end the balance of $3,250. The cost of goods sold will be determined using the formula. Opening balance of $2,000 plus total purchase of $3,880. Minus from that, the closing balance of $3,250, giving us the cost of goods sold for the period of $2,630. When using LIFO, similar to FIFO, we first determine the ending balance, but before that, we already determined that the total goods available for sale for the period is at 280 units with a total cost of $5,880. For sales, we know that under LIFO, we should sell the most recently purchased batch first, and since we are looking at the inventory for the entire period instead of every sales and purchase, we simply deduct 130 units from the bottom. The first 100 units at $22 per unit cost, and the next 30 units at $21 per unit cost, which leave us with 50 units from batch with cost at $21 per unit and 100 units from batch with cost at $20 per unit. And we have in the end the balance of $3,050. Again, the cost of goods sold will be determined using the formula. Opening balance of $2,000 plus total purchase of $3,880, minus from that the closing balance of $3,050, giving us the cost of goods sold for the period of $2,830. For weighted average method, it will be even simpler. We have the total units of goods available for sale at 280 units and total cost of $5,880. All we need to do is to calculate average per unit cost for the period by dividing the total cost for the period with total units available for the period, and we get $21 average per unit cost. Then the cost of goods sold is determined by timing the average per unit cost with the number of sales made in the period. And the balance at the end is determined by timing the balance unit of 150 with the average cost per unit. So we have cost of goods sold at 2,730 and ending balance amount at 3,150. For the calculations of cost of goods sold for the period, we can still apply the formula. Opening balance of 2,000 plus total purchase of 3,880, deducted from that the closing balance of 3,150, to get to the total cost of goods sold for the month at 2,730. To illustrate to you the effects of different methods used, we can refer to the income statement. The only difference will be for its closing inventory and cost of goods sold, thus gross profit. So from the example, if we apply FIFO, we will have a gross profit of 1,270. For LIFO, we will have a slightly lower gross profit, since we sell the goods with much higher cost per unit first. And for weighted average method, we have the gross profit that is in between the value when using FIFO and when using LIFO. To make it clear to you, the differences in amounts for the same example are as shown here. With the trend of increasing cost of inventory in this example, we have the highest closing balance under FIFO, thus the lowest cost of goods sold, since we sell those with lower cost per unit first, and consequently, we have the highest gross profit. We have the lowest closing balance under LIFO, thus the highest cost of goods sold, since we sell those with higher cost per unit first, and consequently, we have the lowest gross profit. And this is why some businesses like to take advantage of LIFO when the cost is at an increasing trend to get lower profit, thus lower tax charge, since tax will be charged generally from profit made by the business. Let us try this exercise. We are given the information that we need to determine the inventory cost using the three methods under periodic system. We have the opening balance of 6 units of goods at $50 per unit. We have the closing balance of 16 units of goods, and the total units of goods available and the total cost for the goods available for the period. Now pause this video and have a go at it. Using FIFO, the 16 units ending balance must come from the last batch of purchase at $62. So the closing inventory shall be at $992. Using LIFO, the first 6 units ending balance must come from the earliest or the oldest batch or the opening balance at $50 per unit. And add to that another 10 units from the second batch at $55 per unit. Therefore, the closing inventory will be at $850. And lastly, using weighted average, we need to first find the average cost per unit, so we divide the total cost amount for the period with the total number of goods available for the period, and we get $57.75 as the average cost per unit. And therefore, the closing inventory shall be at $924. Just to give you an overview of the effects of changing costs to the FIFO and LIFO methods, here we have a summary of the effect to the important information in the income statement. With increasing costs, if we use FIFO, the cost of goods sold will be at its lowest since we sell those with lower cost first. And thus, the gross profit, the net income, and the closing inventory will be at the highest. With decreasing costs, if you use FIFO, the cost of goods sold will be at its highest since we sell from the most recent purchase first, thus we sell the ones with higher cost first. Therefore, the gross profit, the net income, and the closing inventory will be at their lowest. The opposite can be said about LIFO. Given several methods to be used to value inventories, we are allowed to use whichever best describes the flow of our inventory. Well, conceptually, because at times, businesses just use the methods that suit its aim, regardless of the nature of the flow of goods. However, whatever method we choose to use, most importantly, we need to be consistent in using that method, period after period, so that inventories can be compared from period to period. If you do have the need to change the method, you are allowed to do so, but you must justify the change in method. Having said that, just to highlight to you again, LIFO is not recommended by the standard for inventories. Finally, before I end the discussion, I just want to highlight to you comparison in terms of advantage that each method has. The weighted average method smoothes out peaks and valleys in price changes that may occur during the period. FIFO does a great job of valuing ending inventory at an approximate replacement cost, meaning, since we sell the earlier batches first, what left are the most recent batches with the most recent price. Thus, if we want to replace the current inventory with new ones, we can expect the cost to be more or less the same. As for LIFO, it does a great job of matching current costs in cost of goods sold with current revenues. This is because LIFO uses the most recent costs to determine cost of goods sold. That is all for accounting for inventories. In the next session, we will be discussing non-current assets, specifically property, plant and equipment. We are going to discuss the characteristics and costs of PPE, the concept and methods of depreciation, and how we report PPE in the financial statement under non-current asset. To prepare for the next session, please read MFRS 116 on definition, initial recognition and subsequent recognition, measurement at recognition and after recognition, and everything on depreciation. For measurement, we will only focus on cost model. You will discuss the revaluation model in the subsequent course. That is all from me. Until the next one. Wassalamualaikum warahmatullahi wabarakatuh.